Today's Global Macro Live is Custer's last stand. It's a big one. We got a lot of charts, a lot to talk about. Bottom line, Fed Yellen doesn't give, quote unquote, at all on hawkish forward policy stance of the Fed. And you got some wild movements in the markets. Bonds up strongly, stocks down hard, and gold soaring. All of these moves in line with what we've been looking for. Really telling thematic headline that I saw earlier this week. Markets signal central banks are losing awe even if they shock. Meaning, ECB tries to verbally shock. BOJ tries QQE shock. You have negative interest rates. All of this is not having the same impact that quantitative and qualitative, QQE, the new verbiage, have had in the past. Central banks are running into diminishing returns for their use of easy money. The new reality is clear as markets go down that despite the BOJ, the ECB, and the Fed, that the euro and the yen are rising and things are deflating. We talked about this in 2011 when commodity markets started to roll over, when gold broke, emerging markets were not performing or leading to the upside as they had since 2009. We coined the phrase DSR, and we started using it at the time. DSR is simply the degradation of stimulus return, meaning that as balance sheets rise, to trillions and trillions of dollars, yen or euro, that to increase the monetary base or the balance sheet by the same percentage as QE 1, 2, and 3, you have to produce more actual dollars to get that same percentage bang for your buck. Not only that, but this is an asset reflation policy, not a macro market healing policy. Yes, the macro dynamic has stabilized. You have job growth. I mean, we're not saying the economy's in a recession, but you could make an argument that it's awfully close, if not tilting into a recession. You don't have wage growth. You don't have a push in inflation. And without the Fed's balance sheet expansion, you don't have growth in equity prices, which produce wealth, at least on paper, against which consumers can borrow. The consumer is at risk here because DSR is not only mathematical, by nature, it's natural mathematically, and it's natural in the sense that it just doesn't work to the degree that maybe central banks would like. More recently, we cited DSR as a factor right now as to what's going on. We have talked about the Fed cannot allow the dollar to break out. That would work against their mandate. The wild card for this year is a potential decline in the dollar as a result of backpedaling on Fed rate hikes. This was, comments that we have made December, January. Some of this stuff was included in our Outlook 2016 piece. The surprise move of the year could be a rally in gold and silver into mining shares. Is it time for gold and silver to rise and shine? We keep asking. We've asked this. We've used this title for the better part of 6 weeks running. Got gold? As a question. In other words, get some. And 7 mentions of the U.S. dollar in the FOMC minutes. We're going to talk about that in a minute. The level of appreciation, the Fed's trade-weighted broad dollar index since the 2015 peak above 15% has always led to a macro market deflationary crisis, not surprisingly, that you see what's going on. We also mentioned in our Outlook piece 20 currencies, against which the U.S. dollar has risen by 50% or more in the last 5 years, represents 1/3 of global population. You can't have 1/3 of the global population see their local currencies purchasing power go down by half and not expect some kind of macro market event, one that is deflationary as it relates to demand. Now, January 7th, we spotlighted, we've been talking about the dollar. And the first little wiggle came in the FOMC minutes, and we were all over it on January 7th, talking about 7 times the Fed minutes mentioned the dollar. We can't remember seeing Fed minutes that mentioned the dollar more than twice, going back years and years and years. It was very, very glaringly noticeable. Value of the dollar would be a risk. Dollars depreciated further, that's a risk. Participants agree drag is appreciation of the dollar, including possibility of further dollar appreciation is a concern, so on and so forth. You see 7 times they mentioned the dollar as a negative. Then, not long after, a couple weeks later, you had influential New York Fed Bank President William Dudley talking about the dollar. We talked about this, and this is our 2016 Outlook weeks before this, that you would see officialdom verbalized their displeasure with the dollar, and that could get to the point, if things got bad enough, we're headed in that direction, where it becomes some kind of an official G7, G8, G20, whatever you want to say, whoever's involved, statement on the dollar, much in the way you saw back in the 80s and early 90s, talking about weakening accompanied by further appreciation in the dollar could have significant consequences. You were talking about financial conditions considerably tighter than in December as a reason not to hike rates again in the first quarter, coming from a Dudley. And the bottom line is that means dollar, and acknowledging that the financial markets, have a big impact. Now, what's he saying, really? Well, inflation? Yeah, I don't see it anywhere. Yeah, the dollar is high. It would be less deflationary if it was down here. The message was pretty straightforward. And then the most recent move. We got three major, picks here in the first 5 weeks of the year that play out perfectly with what we thought in terms of trying to maybe start to lay the groundwork for less hawkish policy going forward. In fact, a policy that targets the dollar, okay, because every other country in the world using their currency, until the U.S. does, it really almost doesn't matter. This is problematic, of course, and this goes back to our currency raceway theme from many, many years ago. Bottom line, it was words with friends. This was our topic of our Weldon Live. We covered this from the most recent FOMC statement where the words changed, okay? Moderate became, strong. Solid rates became moderate rates. And, inflation remained low, became inflation declined further. And whereas things were balanced, we were assessing the implications for the balance of risk, meaning the balance of risks no longer really balanced, that the balance of risk were in fact now to the downside. So finally, we get to yesterday when, theoretically you kind of have now opened the door or laid the groundwork for some kind of more forceful statement here. And in fact, I mean, you couldn't have, if you're in the home run championship at the Major League Baseball All-Star game, where you have your father pitching to you underhand, you couldn't set it up for Janet Yellen any better than the question that came from a New York representative. What would it take for you to consider cutting rates? Well, we better be careful not to go to any premature conclusions. We don't think that's necessary. Let's remember, things are improving. Inflation is the things holding down inflation are transitory. Again, there's that word. We do not expect that we're going to be in that situation. If it turned out we did, then obviously, interesting word, it goes against the grain of this whole thought process here, would do what is needed. But the bottom line is shrugging off this question like, yeah, no, that's not going to happen. They're very confident in their view. It's as if she looked at the questioner with this kind of look at her face, like, what are you, crazy? Easing? I'll tell you what, the markets are screaming that you can't be tightening at the very least. Bottom line, today's theme is Custer's last stand. And from that perspective, it kind of seems like the Indians, and no disrespect to any type of, this is not a racial thing, it's just very interesting to me that you have a very embedded dynamic, deflation, okay, very much like the Indians. And there's a lot of ways I wouldn't want to compare the two, because deflation is not a good thing, and in this case the Indians were obviously major victims. But from that perspective, this battle particularly is interesting because you have 4 divisions of the 7th Cavalry engaging here in Montana against the Sioux Indians, okay? And we can take the 4 leaders, Custer, Terry, Crook, and Gibbon. You see the columns here, or these 4 leaders, their divisions, as the central bankers, the ECB, the BOE, the BOJ, and the FOMC. It's pretty straightforward. So from that perspective, fighting deflation are central bankers. And the question is, can they win this battle? Or are they underestimating how strong deflation is, to where deflation ultimately catches them at the top of the hill, surrounds them, and destroys them? Now, in this sense, longer term, of course, the Union drove the Indians into the reservations brutally, and won the war, quote unquote won, if you want to even venture to use a word such as that in the human context. And you could maybe think that if central banks just buy every bond ever printed, they could win the war too. but maybe not. This is the real question here. You know, is this not going to work anymore, and does it even matter anymore? Is the DSR so intense that it doesn't matter what the monetary authorities do? I think you still have several steps to get to that point, but for now, the onus is on the Fed. It's not a one-step process to get to easing. It's 2 or 3 steps, and Yellen really highlighted that yesterday, and here's the problem. The problem, of course, is tightening into this macro backdrop where everyone has seemingly forgotten about the fact that debt keeps rising, keeps hitting new records pretty much every month. The federal debt outstanding right now, or not federal government, general government debt outstanding, public debt outstanding in the U.S. just topped 19 trillion. I remember when it topped 5 and then went to 6 during the Bush years, and people freaked out by that. People, it's at 19 trillion. It's more than doubled under the current president. And no one talks about it. No one talks about it. Don't hear any talk. In the meantime, the Fed has stopped buying. They're tapped out. Returns on the stock market are tapped out. The consumer is tapped out. God forbid, energy prices go up. That would be a real problem for the Fed. Real conundrum. Watch what you ask for. You just might get it. But the bottom line in this is that despite balance sheet expansion, you see this here, relative to the growth in outstanding debt, okay, you're down. I mean, it's, you're losing ground because debt has grown by more than 3 times as much as the Fed expanded their balance sheet. To have any impact going forward, the Fed would have to expand their balance sheet exponentially more than they have in the past. This is a reflection of DSR, for sure. The still steep slope of the dot plot, even though it's come down, okay, is part of the problem because that's supporting the dollar. And while flattening the dot plot might weaken the dollar index, it won't be enough to squelch macro deflation because it's not an easing. Okay, you're undoing a tightening that never even happened. All of this never happened. The tightening never happened, even though it drove the dollar sharply higher, and the easing won't happen, and it won't have the same impact on the dollar. It's going to take stimulus, I believe, or some kind of concerted, verbalization or some kind of plan to keep the dollar from continuing to rise. In this case, Janet Yellen is Alfred Terry, who is the brigadier general that pretty much ran the entire 7th Cavalry during the Battle of Little Bighorn. Now, the FOMC, of course, talking about tightening, of course, the dollar strengthens because everyone else is easing. Think about what the Fed would have to do to get the dollar down on an interest rate differential basis when you have so many countries already at negative rates. This is a real problem, man. And when we talk about what the foreign central banks have said, we know. We've seen this slide before. Japan won't hesitate. They already eased since we first used this slide. Draghi looks sinister here. We have the power, willingness, and determination to act. There's no limits to our actions within our mandate. Man, he has been awesome in terms of using verbalization to manipulate markets. And the DSR on that, in fact, is also waning very quickly. Progress has been insufficient, BOE, so on and so forth. What's the real comment? Well, again, don't see any inflation as far as the eye can see. Draghi's laughing all the way to the low bond yield bank, okay? And the BOE is just like, are you kidding me, man? Let us pray, because the 2-year gilt yield, we said this 2 weeks ago, and all of a sudden we see it all over the headlines today as gilt yields make record lows. They were below the base rate at the 2-year level 2 weeks ago, and that was a real sign that the gilt market was on fire. From this perspective, okay, they're all in cahoots. Okay, the 7th Cavalry is global central banks. Okay, unfortunately, Karuta is George Custer. Brigadier General Crooks goes to Mario Draghi, and we see here Colonel John Gibbon is represented by the BOE's Carney. One voice that speaks the truth, no forked tongue here, is the BIS, and talking about how you cannot rely on central banks, to save the day continually. At some point, that's not going to work, and you go ahead to what are they really saying? Well, we have this much time, very, very little, to the proverbial stuff hits the fan. You're pretty much into that phase right now. You're desperately trying to hold these lows in the S&P pretty much as we speak, and failure to do so would be technically devastating. Again, in line with what has been swept under the rug, and nobody seems to care anymore, it's debt. Okay, and we look at Europe and we say, where could there be another surprise that we haven't even talked about yet in our 2016 review? Okay, we talked about it last year. It didn't play out last year because the ECB was more aggressive than we thought they would be. Okay, they might be more aggressive even here, but they're already parabolic in the growth of their balance sheet just on a projection forward basis. It's going to take a lot to get them to be as aggressive on a relative basis. Again, DSR means you can't just go another trillion. You're going to have to top that if you want the same bang for your euro buck, so to speak. Bottom line, Italian debt is at a new high in December, over 2.2 trillion euro. As a result now, finally, especially with stock markets, I mean, you got no growth, you got stock markets deflating, that's going to be real hard to meet your growth expectations, and all of a sudden, the debt is not only nominally at a new high, but if GDP were to come off, then relative to GDP, the way they measure it, it's exploding to the upside. Okay, 135 or higher for Italy in terms of percent of GDP in debt, just on the government side, let alone public, consumer and corporate debt. Bottom line, credit default swaps are stirring. They're perky. Here's the Italian 5-year on the weekly basis, breaking through the 2-year moving average and breaking above the previous high set in 2014. Not only that, but here's the credit default swap against total government debt. I mean, this gap doesn't make much sense. This is obviously not a black and white comparison, but it's pretty interesting. You can kind of see how when it accelerates, you get a little push here. Certainly from the perspective of 2011 and the EU debt crisis, doesn't seem to me you're that far away. Same thing with the 5-year Italian bond yield. The ECB through QE has effectively kind of capped the yield curve, suggesting originally at the 2-year level, and now that Draghi has said this could be open-ended, has pushed it out to the 5-year level, where you're getting a lot of bang for your buck in terms of lower rates. And how much lower are they than they might be otherwise? Well, the CDS implies a 2% Italian bond yield. That's a lot higher than the 0.6 where you are right now with QE from the ECB. But bottom line is the longer end, okay, and the CDS market looking a little perky. Here is the 10-year BTP pushing for a breakout above the 52-week moving average and above the previous high with a very tight technical pattern here and bullish divergence in the stochastic. In terms of Spain, government debt, record high in the third quarter, more than 1 trillion euro. You throw in interest payments closer to 1.3. And the Spanish sovereign credit default swap getting a little perky here too. We'll keep an eye on that. And the Spanish 10-year violating this uptrend line, violating the 100-day moving average, a nice little head and shoulders bottoming pattern. Gets through 184 and then 2%, and you've got some upside room in the Spanish 10-year. We also note in terms of Portugal and Ireland, two countries that have had attention in the past, the bond yield, the credit spreads are blowing out. Here's the Portuguese-German 10-year. I mean, it's gone from below 2 to almost 4. That's a big move, man, and a major long-term breakout. This is a very telling chart, as is this one too. Ireland against Germany, also breaking out with bullish divergence after setting new lows at a really tight 16 basis points. That's amazing. Now, when we look at the EU and debtor nations, we have to have perspective, because not all is necessarily as it seems. And again, as you could say this with mortgage bonds back in 2007 in the great movie, The Big Short, great book, read that book, awesome book, good movie, really good movie. Bottom line is, okay, Germany, Netherlands, Austria, Finland, not really Finland, but Belgium, France. I mean, let's look at these 5. Belgium, France, Austria, Netherlands. Double, AAA, no problem. They're core EU, right? As opposed to Ireland, Spain, Italy, Portugal, and Greece, which are rated less by S&P, Moody's, and Fitch. But if we twist things around a little bit, and we're not talking about manipulating the data, we're talking about just taking a different perspective. Euro per citizen. Okay, we use Italy to adjust because Italy is the highest nominal debt. Okay, the picture is entirely different. Okay, in the top 5 are 4 of those core countries in terms of population-adjusted debt levels. Belgium, Austria, France, and the Netherlands. We have called Belgium, Austria, and Netherlands repeatedly since 2010, before the 2011 crisis, our sleeper cells. Because, and no disrespect to the countries, but these, from a debt explosion perspective, these are the places where you could get an event that you really were thinking it's okay there. It's AAA, right? No problem. Whereas like Portugal, for example, closer to Germany, Italy, Greece, and Spain, locked down with Portugal and Germany. That's an interesting perspective. They're all at risk is the point. It really is. Dutch debt at a new high, $452 billion. It doesn't include interest payments. I mean, it's almost doubled in the last 7 years. This is a time they're supposed to be paying down debt when they have the opportunity of a generation. with low interest rates to restructure, to reorganize, and to work this problem out, and they have actually just gone on a whole nother spending spree. It's mind-boggling that this is the situation, and even more mind-boggling is the complacency around that, and this could change very quickly here. In fact, I think it is. But it's a AAA, and I love the old song by Soundgarden. I mean, looking Minnesota, feeling California. Was it the other way around? I forget. But, I mean, the Dutch 10 years looking AAA, but feeling like a B. Okay? Dutch sovereign credit default swap. It's above the 200-day moving average for the first time since the 2011 crisis. That's interesting. There's a close-up. It's made a decent move. I mean, it's still very low, but it's made a decent move on a relative basis. Belgium, same thing. Looking AAA, but feeling kind of blue. We'll say blue. It would have been better to have blue in there as a B, but feeling blue, B blue. Just don't buy. This is going to, it just doesn't seem to represent value, in Belgium and the Netherlands at these interest rates. Problematic. Belgian-German spread, we're going to keep an eye on this. This breaks out, that will really be telling through 32 basis points. And the Belgian 5-year credit default swap. There's the close-up. It's a decent-sized move. Gathering steam, for sure, in the last couple of days. Now, back to our theme, okay? Because we're now going to talk about Japan. Japan is Custer, unfortunately, coming across here, thinking they're coming into a virtually deserted Indian encampment that's going to have old people and women and children. And lo and behold, there were thousands of crazy horse, troops waiting there, chased them across the river, up the hill, and ultimately they were slaughtered on the Little Bighorn. The Bank of Japan is like Custer. I mean, basically thinking they have this and continuing to just get pummeled, okay? And at what point are they on top of Little Bighorn looking at, at a slaughter here? Bottom line is they have continued to expand, called in monetary reinforcements, okay? You're actually ahead of the pace right now to get to where the BOJ says they're going to get. Going down the road, here it is. 80 trillion is their target rate annually, according to their policy, and you've been running above that really for the last 2 years. So from that perspective, you can see every time they've increased 20 trillion, they made the peak. Then it was 30 trillion. Then it was 60 to 70 trillion. They gave you a range. Then they busted it up to 80. Now they got QQE, and still, even with the explosion in the monetary base of 300% in the last 10 years, okay, the monetary base growth, which is almost perfectly tracking the BOJ's annual, growth target and pace of growth. But look at this decline. This is a massive decline. Very notable, particularly when you see it here in the monetary base, but not here in the BOJ's balance sheet. This is troubling. This is troubling. That's a sign of problem. Not only that, it's a sign of a problem when you have outstanding government debt of more than 1 quadrillion yen. Now we know it's yen, okay? But it's a quadrillion. I mean, I remember when we first started using terms of trillions. I'm that old in the business, 30 years. Back in the 80s, if you were talking about a balance sheet on the held by the Fed of $4.5 trillion, people would have looked at you like you had no head. Okay, like you were insane. 1 quadrillion yen, outstanding. And yet all of this, and you're still standing on top a Little Bighorn, getting decimated. Inflation falling back into deflation and accelerating to the downside. Abenomics is at Custer's last stand. Now, back to the markets here to finish it up. It's a long one, but it's a good one. Goldman Sachs has abandoned 5 of their 6 top trade calls. This is symptomatic of a bigger problem. Goldman Sachs serves so many hedge funds. They kind of all play ball in the same little pool, and right now that pool is an absolute bloodbath. Okay, inflation bet gone wrong. Expectations for inflation to go up, they've gone down. In fact, they've made new lows. New all-time lows. Expected the dollar to continue rallying. We thought the dollar would continue rallying against emerging markets, but thought the yen might rally, and that would keep the dollar index down, and that's in fact exactly what's happened. And then expecting, the emerging markets to perform and lead higher, and that hasn't happened. In fact, that was we're on the other side of this trade. Okay, and they thought the banks in the U.S. would rally and lead the way higher. The regional bank index against the S&P 500 is down 10% year to date. Our outlook, okay, we're 5 for 5, and I would say 6 for 6 if you included the yen part of the currency wars, that it would be the opposite of dollar strength against emerging markets. The opposite would be that the dollar index wouldn't keep pace because the yen and possibly the euro would strengthen. So from that perspective, it's kind of two trades in one, would give us a 6 for 6 with a walk. And we say a walk based on the tropical and agricultural commodities have not worked. They haven't not worked, but they haven't worked either. But every other one of our themes in our 2016 Outlook published on January 5th have played out, and have played out in a big way. Okay? Gold. Boom. Today's the day. Hope you got your gold already. Hope you got your gold on our Outlook piece. Hope you got your gold, and wherever it was for our new trial subscribers that you found us, because we've been banging the table on this. Again, we have a long leveraged, very aggressive gold precious metals program. As a managed account that we offer as a CTA. And I'll tell you what, we wish we had raised more money here back in January because right now that would really be paying off. And it's a long-term breakout. It's got further to go. It's not too late. It's not too late. You get through 1308 and this thing has significant upside, particularly if what I think is going to happen here monetarily and central bank wise happens, and that means a real turn on the dollar. The junior gold miners is one of our favorite plays here because it's cheap relative to bullion, cheapest it's been in 20 years, and the GDXJ breaking out here and breaking out relative to the S&P. Short term, nice pattern. This is a really strong chart, and on a longer term, again, suggests the adjustments here are early stage, despite the fact that gold is up $50 today. Okay, I still think it's early stage. I'm not saying run out and buy it at today's rate, but this thing drops $30, $40. You got to back the truck up right now. We also have been bullish on the bond market relative to stocks and on an outright basis. Here's the TLT, gaps up, and really it's become a gap and runaway move here in the TLT, really paying off. And we've said rock and roll hoochie coo is one of our themes for 2016. Buy the bond, sell the SPOO. And you can see new highs going all the way back to 2013 in this ratio using the ETFs. As for the stock market itself, deflation in stocks, tapped out. Equities was another one of our themes on its own merit, regardless of bonds, each of them on their own merit, and then together it was just a perfect play. And you can see here, this is the lowest close, going to be the lowest close in the S&P, on the verge of a major breakdown here. 1812 was the previous low. This thing is set up for some real downside pressure. I think that you see a very similar kind of trading pattern here too, right in here, and then boom, to the downside. On that front, we've been bullish on the bearish ETFs. Here's the SDS, again, kind of breaking out. Really, despite this move to new lows, we still liked it, and that's paying off now as well. And again, still think potentially early stage. You get this thing above 2560, you have some real hardcore upside room. The oil-telling U.S. consumer tapped out, ties back to our mother of all overlays with the Fed's balance sheet, the VCR at a new low, complete breakdown here, bearish divergence, one of the most overstretched to the upside markets I've ever seen, thanks, of course, to QE3. Once that ran out, are we surprised this is happening? Are we surprised this is happening? It's Custer with no reinforcements because the Fed is not in play and no longer willing to play and saying we're still moving the other way. Comments from Yellen yesterday were key. The consumer discretionary versus staples leads the way. Of course, discretionary performs better if the consumer's in better shape. Case closed right now. Bearish divergence and leading to the downside doesn't bode well for the broader stock market. The regional banks breaking down, and that leads us to Europe, where it is a bank problem. Sovereign debt issues would only exacerbate this, could get real ugly. Already the banks are breaking down, many of them at new lows. We've been featuring them for the past couple of weeks. Here's the Euro Stoxx Bank Index, and here's the Euro Stoxx Bank Index relative to the Euro Stoxx index itself. New lows, Euro Stoxx breaking down, major long-term technical breakdown. You're below the 2014 low. You're going to 2000, and that's another 30%. I mean, that's a big move. Bearish divergence to the max here. In currencies, to complete and bring it full circle and finish it up, in terms of currencies, the yen. We've liked the yen, and it really paid off this week. Here's the move in the Japanese yen, breaking out to the upside. Okay, but in the context of that, that is part of what's keeping the dollar index down. Strength in the euro and yen, just as we expected, has not interfered too much, at least, with our emerging market play. which continues to gel. But note the breakdown in the dollar here. It is somewhat significant in terms of the technicals on the dollar index itself. Okay, and yet the Fed's trade-weighted dollar index is going to close at a 12-year high in February with a really tight technical pattern. Why? Because you still have crude under pressure. You still have emerging markets, in turmoil. Here's the Mexican peso. It's imploding in February. It's going to close today at a new all-time closing low. It's the dollar, Mexico is up 12% this year already in 5 weeks. Russian ruble, same thing. This will be a new low monthly close if we hold up here going out through the rest of February. Likely to happen unless you get some official word on the dollar. Now, the breakdown in the gold-adjusted value of the dollar is the most telling. It's the most telling as it relates to the Fed and reflation versus deflation as the outcome of their policy. And right now, it is screaming that the Fed is too tight. The Fed is too tight and needs to loosen to the degree that it actually, turns and not only lifts gold, but lifts the stock market too. And I'm not saying that's the right thing to do. It's not, but it is most likely the thing they will do. It's a question of how do we get there and how much more pain do we have to represent in terms of deflation and its brutality. Let's be real. I mean, the Indians certainly victims, but at the same time, the anger that they, had to, generated as a result of the invasion of their land, justifiable anger for sure, resulted in a lot of brutality on that end too. Crazy Horse and Sitting Bull represented the deflation side of all of this. If the cavalry is the central bankers, and from that perspective, I don't know that we're going to have any monuments built to deflation anytime soon, as they've built a monument to Crazy Horse, who was truly an American hero, and like using that word American, because he, original American hero. The American hero right now is gold. It's the global hero in this time. And again, shameless self-promoting. I know, all humility aside, it is a really distasteful part of the business for me, but we got to do it. And when we believe in the opportunity, we do it. And right now, we believe the opportunity for the precious metals still exists. Today's $50 move notwithstanding, we offer information to anyone that would like to get some. Just email Caitlin, and we'll be happy to reach out to you.